Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Andrew ShutSky. Andrew has over 15 years of real estate investing experience, beginning with a house hack of his first home in 2007. He is currently an active and passive investor in over 1,300 units, and his firm, Redline Equity, has over $70 million in assets under management. So thank you so much for being on the show, Andrew.
It's a pleasure to be here. Thanks so much for having me on the show.
So tell us a little bit about yourself, both personally and professionally, prior to getting involved in real estate investing and taking down that first house hack in 2007.
Yeah, so I'll take you back a couple of decades, and going through college like any other normal adolescent, semi-professional, or working professional, not knowing really what we wanted to do. I always had a number of passions, one of which was technology. So I went the typical, hey, let's do 4 to 5 years in college, do your internships, start a working career. Went well, a trajectory went well, continues to go actually in that direction. But there's a couple of things that became glaringly evident to me during those first, let's say, decade of my career and going into now 2 decades of my career on the W-2 side. One is that, hey, I enjoy what I do, but I don't know that I have complete control over my destiny, right? In fact, I know that I don't. I hated paying, and I continue to hate paying so much percent of my income in taxes. And I needed a way to diversify income. And I explored a number of different pathways to other passions in the automotive side of things, electronics, to home theater. And I'm like, okay, these are hobbies. And in the back of my mind, I knew I've always been interested in real estate. I started with my first house hack, like you mentioned, just about 15 years ago. And at that time, it was kind of a hobby. And I thought I'd continue to grow and expand, one single family home at a time, and quickly realized even with a decent income, you can only save, a certain percent of your income per year, quickly run out of money. About 5 years later, after that house hack, I pivoted towards the short-term rental space, continue to own and operate some of those units. But again, same constraint. I love that body of that area of expertise, the short-term side. But again, quickly run out of money. Fast forward another, let's say 7 years, I stumbled on a thread online you may have noticed, a site called Bigger Pockets. It's a little bit known out there, and learned about this area of multifamily syndication, which is sounds like a very daunting word to those that don't know, but for me, something clicked, and I was like, wow, I didn't know what I was looking for until I stumbled upon this thing, and from that point forward, I went all in. Read 30 to 40 different books, hired a mentor, joined multiple mastermind groups. Within a few months, found my way into a first partnership with a small role, continued to expand that, and I feel like I found my stride. So that's a long-winded way of answering your question, but that's been my journey in the past 3 minutes and covering 20 years.
So what was, I didn't know that you had started in doing or working with short-term rentals prior. What was the issue that you mainly found there? Obviously, you said you ran out of money, but was there any other constraints that you were finding?
Yeah, I mean, it's time consuming as well. So even with an unlimited budget, your ability to scale quickly, and if your goal, and it all depends on what your goal is. And at the beginning, to be honest, I didn't know what my goal was. It was just, hey, let's make some money, let's have some fun. let's diversify income. But if your real goal is financial security, I hate to keep using the word financial freedom. It's just like, for me, that means being able to do what I want in my own terms without having to answer to a third party. If that's your true goal, unless you're fortunate and blessed with 7, 8 figures of money to play with, your ability to scale is very limited. And even if you do have that money, it still consumes a disproportionate amount of your time. So that was the main constraint. Those two things were really financial, the ability to bring capital to close a property in short term, and then the time commitment to own and manage those properties.
Interesting. Yeah, I've heard different strategies with people getting started in short-term rentals, and it's like, I always kind of steer away from them when I'm listening to them, because it's one of those things where people are saying, well, you can sublease stuff if you don't have it. And you're like, this just gets riskier and riskier, because I mean, you catch yourself in like a 2020 kind of situation again with COVID. And I mean, if you're in this certain state, you won't be able to rent them forever. You know what I mean? I mean, a year or so, and you're still paying that rent. You know what I mean? So yeah, that's one thing with multifamily, as I find as well, is that, like you were saying, it's the constraints are really limited, because we don't have that much of the supply out there, and we need more of it. And these governments know that. So it's something that kind of goes hand in hand with that.
Yeah, absolutely. And it really comes down to, especially if you dive into an emerging market or a booming market, the risk is inherently even lower because the demand supply imbalance is even greater.
So what types of properties are you and your team really focusing on now, Andrew?
Yeah, we're looking for a very specific niche, and it's not that uncommon in the space. If you're in, we're looking for specifically Class B, Class C properties with some type of value add potential. And when I say value add, I think more and more of us are getting creative in that space, right? And traditionally, you might go find a 1970s, 1980s vintage property that hasn't been renovated either in an interior or exterior, and go and renovate them, raise the rents to market rates, and then refinance or sell the property. In today's world, those properties, they're still out there, but there are less and less of them. So I think, myself, my partners, my teams are getting more creative in things like on the operational side. What can we do around the property management? What can we do around sources of other income? Whether it's examples like valet trash, or it's other things like adding a washer and dryer to a unit, or cable and internet packages. These days, you got to be creative. There are deals out there. They're just not as glaringly obvious as they were when there's abundant number of Class B. Like I said, classic interiors, 95%. There's still out there, but they're a needle in a haystack in these big markets.
Yeah, for sure. With your Class C properties that you have now, are you seeing any changes in rent collections or anything like that?
Actually, no. I mean, we picked up a couple last year, and the situation has improved quite a bit since we've closed on those. And the properties that had collection challenges still have some to a lesser degree, but it's not to the point where it's impacting our business plan, to be honest. I mean, I think we were fortunate. Inflation's both a curse word and a blessing these days, right? Yeah. We're fortunate to see a pretty big influx in rent growth, even in markets that we had underwritten probably half of what actually came to fruition. We were fortunate that even with debt collection not quite being where we wanted to be, let's say we underwrote 1% or 2%, maybe we're at 3 or 4, but rent has gone up 15, 20%, which really helped profitability.
Wow, that's great.
Yeah.
What I found is why I asked that question is because when speaking to a property manager just a few days ago in Tampa, which is obviously one of the hot markets of the United States, they're saying in some of their C class, they're seeing delinquencies up to 15%. So it's just, obviously it's per property, it's per how it's managed, how the quality of it, when they took over management, there's so many different variables. So
right. Yeah, absolutely. And it could be very dependent on a specific, market niche. And one of the things we look for to try to avoid situations where you're too dependent on a particular employer or a particular industry is look for employment diversity. So if you have, let's say, a school that's hit really hard, or one manufacturing segment that's really hard, if you have a Goodyear or Michelin or something, and they take a hit, that risk is offset by diversity employment, both size, both industry, and across just different employers in general.
Interesting. So Andrew, tell us about like building a team and how that's helped you close deals while working full time and having a family and doing it so quickly after just being introduced to it.
Yeah, the reality is, I mean, everybody has a couple things, or maybe one or two, or if you're really lucky, three things you're really good at. And it took me a while to find my stride with that. Is in the beginning when you're starting out, you don't know what you don't know, and you're trying to cover a lot of bases. A lot of us are go-getters, class A, overachievers, trying to cover the world, DIY approach. And the reality is you can only go so fast, so far on your own that way. So to me, the biggest game changer, and I continue to refine what my scope of this and what this looks like for me, is like finding people that have similar values, but complementary skill sets. And that only can create exponential growth. And I learned that the hard way, and a painful lesson, trying to balance that with, working 50 hours a week in the day job, being a family man and lots of hobbies and friends, and trying to keep my social life somewhat alive.
Interesting. So if you had to do it again with starting from 15 years back with a house hack, which I think is always a great way of starting, but what would you have changed on your journey to getting where you are now and where you're going in the future?
Yeah, I think the first thing that comes to mind that you just mentioned is, instead of trying to go at this myself, one property at a time, go network my way to find the right partners with the right mindset, similar goals and aspirations, but complementary skills to go faster. So building a team, and then changing my focus, and I'll call it the focus locus, from the single and short term to the larger, even if it is joint venture based, on either larger or mid-sized apartment buildings, just for the sheer fact that you get more bang for your time.
Yeah, that's great. Yeah, it's easier said than done when finding partners, because it's difficult to find partners, like you said, that have complementary mindsets and qualities, but also finding partners that are as serious as you are. Yeah. And obviously us both being very serious people, and you're finding partners. Yeah. When you're working with someone, they're like, oh yeah, I want to do it. And they really don't want to do it. You know what I mean? Right. They just went to the meetup, or they went to this conference. So it's it becomes more difficult. I know you joined a mastermind. And when you're inside a mastermind, I've joined a couple myself within real estate. Yeah. It's just one of those things that you hate to have to join or do stuff like that, but you find people that have kind of really invested into what they're doing. And when you're in a mastermind group. So tell me what you think about that, Andrew.
Yeah, I will say, here's my lessons learned from mastermind groups is, you don't know going in, just like anything else. And you think you're going into a group of equally motivated individuals. And the more of these groups I join, I think the faster my filter becomes on who do I want to work with in this team. Now, obviously people join with similar interests and passions, but, very quickly, I shouldn't say very quickly, in the beginning, it took months, but more quickly, the more often you expose yourself to these groups, you realize who's really on your same page, same energy level, same wavelength, same values, versus who's here just to kind of dream. And I found that the first couple of groups I joined, there was 80 to 90% of them where I wasn't seeing them making offers. I wasn't seeing them making engagement brokers. There's just some hesitancy there. And that's really what I was looking for, someone who's got similar energy to me, similar motivations, similar goals. But again, the complementary skills. And it's rare, to be honest. Like you said, it's not easy. And it takes exhausting amounts of discipline and consistency to keep engaging and keep doing that. I'll call them speed dating rounds with, hey, grab a coffee with somebody, grab a beer for 10, 15 minutes, grab a virtual Zoom meeting on a Friday. You may not feel like it, but the more people you expose yourself to in these smaller groups, the greater your probability becomes of finding the right partner.
Yeah. And the other thing too, is when you start actually doing deals or being part of deals, or however you'll measure yourself, just moving forward, people will reach out to you and want to partner, and hopefully, those are most likely people that are going, you can kind of cherry pick those people and find out who you're going to partner with. But it's really just kind of like, movement, kind of breeds more movement. And it's very interesting. But so one question I had when I was doing some research for this episode is like, when potential passive real estate investors are pondering whether they should invest or not in real estate, and we've all had these conversations, and it's usually the stock market is usually the other investors kind of like investment option. So you've invested in stocks for over 10 years. What would you consider to be the main pros and cons when compared to multifamily real estate investing?
Yeah, I think about, like you mentioned, it's actually been more than 10 years since I've started dabbling in the GEs and mutual funds of the world and buying different securities. I'll always hold a portion of my, our wealth in the stock market. Again, I grew up with 401ks and things like that. The biggest thing with that is the volatility to me. So you have no control, no insights in these companies other than what they publicly report. You have no, there's nothing you can touch and feel. It's not tangible. Again, with real estate, phenomenal. Downsides to real estate, especially in multifamily syndications, are, hey, you've got to trust the group you're in. And I see that as much of a pro as a con, because you're hands off. It's absolutely, completely important that you trust the right team. You pick the right team, you pick the right property. The holding period, right? You got the liquidity issue with real estate. But again, if you're thinking longer term, 2, 3, 4, 5 years, our typical hold periods, as long as you're okay with that, not as much of an issue. But again, it's something I can touch and feel. Historically, much more stable. Historically, rents don't go down. And historically, you can weather recessions and things like that really well in multifamily compared to stocks, which if you've been through 2008, 2009, you know how that went.
Yeah.
So other thing I look at is tax, right? I mentioned how much I really dislike and displease the January, February timeframe every year when my accountant gives me the bill. And that's another thing you get it with stocks, especially if you're a short-term trader, which I did for a while. You're getting hit with a third, 40%. I just hard to stomach that, but again, it'll be a balance for me, but my balance is shifting a lot more towards real estate, especially as I get, more and more passive income on a month or quarterly basis under my belt.
Yeah, real estate. It's one thing with real estate is I find is that if you invest in the real estate, and people always, I'll talk to a lot of stock people and they'll talk about the liquidity. I personally don't mind the liquidity. I like the idea of setting capital for 3, 4, 5, maybe 7 years if we're going through some sort of downturn, and not having to worry about it again. You know what I mean? You're setting it. I don't have to underwrite another deal again. If I'm active in that deal, then you're just running the deal, right, with your other partners. If you're passive, then it's up to the operator to run it. But it's something that it's not like with stocks where I'm like, you have to be watching screens and doing stuff and like consistently, you know what I mean?
Right.
And it's like, slow. Real estate is a lot slower with stuff that's happening. It's not going to be, And the other thing too is it's very difficult with real estate to lose all of your investment. Possibly if you're in a real estate syndication and 75% loan to value or 70% loan to value, I mean, maybe worst case scenario, you lose a few percent, but it's very difficult. I mean, when you're looking at it over the whole thing, if the property's cash flowing when you take it over, you know what I mean?
I'm a big statistics guy, right? So I look at what's the probability of things. My wife, she finds this hilarious. She's like, why is everything a probability to you? I'm like, look, it's not an emotional thing to me. It's if I look at what's the probability of losing 1% or losing my entire investment. If you look at real estate, land never goes to zero. It's pretty unlikely with ample reserves and the right team with experience that they'll default on a property, right? It happens, right? But again, like you talked about, leverage, using that effectively, using debt service effectively, having the right team in place, running the right operations, having the right PM, that risk is significantly lower than it would be with, hey, if I go buy Bitcoin, I could lose half my money in a month.
Yeah, 2/3 of it.
There's a time and place for that too, but I equate that more of the Vegas, entertainment level than I do a true institutional grade investment.
Yeah. The other thing too is even if you don't add, even if you go into a group and they don't add any value to the property and the rent stays the same and everything like this, or rents go up by inflation, I mean, you're still paying down debt. I mean, you're still becoming safer every month on that property in a better position. Yeah. And, I feel that the longer you own property, the less risky it is. So
it is. If you think about your summation of your cash flows too, let's say you invest $50,000 or $100,000 and you start distributing second quarter, third quarter, you're getting that, whatever that pref would be, 6, 7, 8%. So by year 2, you've recouped a good chunk of your investment already. And if you were to default at that point, you've already made some of your money back. So again, getting to zero value would be pretty difficult to do, honestly. The stars will have to align in the wrong direction. Yeah.
Of course, especially if you're in one of the markets that we really focus on, you and I, in growing markets, there's always going to be buyers that want to get into those markets. But
and that's what we look for really is like, how do you really stack the deck in your favor? Is you buy into a market where, hey, it hasn't reached its plateau. And there's a massive demand supply imbalance. Like if you look at my background right now, for those that are on video, it's just under contract in a property in Greenville, South Carolina, historically under the radar, but it's becoming now, right up against the Charlotte or Atlanta, and it's flown under the radar for some time. And now there's a massive building frenzy going on because of just trying to keep up with demand and the jobs going in the area. So
fantastic. That's great. Yeah. So when you're raising capital, Andrew, what have you found to be the most beneficial ways of building credibility with your investors?
Yeah, I think what comes down to one word: education. And I'm not here to be a salesman. I'm not here to, try to pitch something. It just really I think one thing that holds a lot of people back from the biggest thing that holds people back from professional, W-2 professionals or business owners is from investing is just lack of education or awareness. Oh, that seems so risky. What about, why wouldn't I just buy one property at a time? Why would I put this in other people's hands? Well, a lot of people just aren't aware of the benefits. So I see it as my job to be an educator, just more like a professor, right? And in the sense that like, hey, and along the way, I'll share some opportunities I've vetted, I've come across that I'm investing in, and offer you the same opportunity. So it's as simple as that for me. It's not a sales role. It just is much about awareness and education as anything else.
Interesting. So what are common mistakes that you see real estate investors make?
Oh man. So I'd say, the last couple of years where we have significant cap rate compression has covered up a lot of poor operations or lazy operations. So, not staying on top of asset management duties. Again, we've gotten away with that as a whole, as a profession in the last couple of years. And you see a lot of, okay, yeah, I'll let that property go for a couple of months. The PM can do their own thing. You see them, renewed leases at the old rates, not stay on top of upkeep and maintenance. Some operators out there have underraised capital and run out of money, things like that. They're probably the most common I've seen in the last couple of years from different operators and, other partners who have struggled with certain things.
Yeah. And when that market cycle turns more kind of flat and sideways versus going up, that's when you're really going to see the true operators that are able to change management to increase profitability or to hold profitability, even with costs going up. And that's a lot of work because you can't just get reports from your manager and say, oh, everything's fine. Everything went up and stuff like that. Now it's really like, hey, you have to be more active asset management. And I don't think a lot of people really have the experience in doing that.
One of the things I've gotten really selective on is when I look to partner with an operator, again, because my role was mainly around investor relations and raising capital, due diligence, earnest money. So when I look for an operator who does this full time, one of my big screens in my brain is, are they off just chasing the next deal in the middle of closing one deal? I don't want someone who's like the Walmart of syndicator, right? That might be great. They get access to good deals, but I want quality over quantity. And if someone is quickly chasing the next deal rather than stabilizing their first, that comes out in my reference calls with investors. It comes across with my reference calls with other partners. And it's easy to sniff that out now. So that's just one tip I have for those looking. If you're looking to partner with someone, just make sure your values and your level of aggressiveness and growth versus quality is aligned with theirs.
Yeah, I totally agree with you. I've seen that a couple of years ago with one operator, and you weren't getting timely reporting. And you're like, well, what's going on here? What's happening here? Right. And they're doing something crazy, building something new or whatever it is, and you're like, well, still got this over here. You know what I mean? And so it's really important that they have a solid, and the best operators that are growing portfolios, and they're growing their team as well alongside them.
Yeah.
So, I mean, just that there's accountability, and you're getting reporting on time, you're getting calls on time, everything like that. And they're not, like you said, all the way down the road now and on more deals, and forgot about the one that they closed a while back. So
you nailed it, man. And there's absolutely nothing wrong with having huge aspirations and going big really quickly. But the one component is having the team behind you to support it, right? So if you're trying to close 4, 5, 6, 8, 10 deals a year and do the asset management, the acquisitions, the debt work, working with legal, working with investors, and trying to do that with a 1 or 2 person team at that scale, it's going to be either going to stress or burn yourself out, or you're going to fall behind in areas like you mentioned, whether it's, getting your K1s out on time or getting your monthly and quarterly reports, keeping up with distributions, keeping up with asset management. It's very hard to balance them and scale at, dozens of properties a year.
So what do you think are the main factors that have contributed to your success, Andrew, over the years?
Trial and error. A little bit of that, truthfully, but no, I mean, really for me, it's been just keeping consistent with daily habits and refining and building partnerships and teams. And again, like I mentioned, lessons learned even from as close to a year or two back is, depending on what your goals are and how much time you have available and what you're trying to balance and what your priorities you have in your life, is really going after finding partners to go faster, a lot more quickly. Right. For me, it's just been my habit of consistency, and I'm just relentless with that. Of whether it's devoting a couple hours a week to promoting your thoughts and content and social media, you may not feel like doing that, but it's so important to get your message and word out to as many people as you can, to help as many people as you can. And it could just be, like I mentioned, even when you don't feel like it, get yourself out there, promoting your content, building education, building an education and thought leadership platform, being consistent with communication to your investors. Again, the key word is consistency for me.
Yeah, I can say it. The right things consistently.
Mm-hmm.
How can our listeners learn more about you and your business, Andrew?
Really simple. I think everything funnels through our website. It's investwithredline.com. Our firm's name is Redline Equity. Very closely tied to our automotive habit. And we've got a podcast out there that's funneled through the website as well. It's called Crushing Cashflow. Check it out. But on our website, again, everything investwithredline.com. Got a free 8-part learning series that kind of gets you through our system, gets you access to our newsletter, all the cool content we're putting out on a weekly basis. So check us out.
That sounds great, Andrew. Well, thank you so much for coming on today, and looking forward to connecting with you here in the near future.
Thank you so much for the opportunity, Charles. Great talking to you.
Talk to you soon.
Thanks, man.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.